Hi, my name is Rahulan Ganeshan, student number 11612204, and accounting and financial management student. Here I am to talk about the assignment 2, which is understanding financial statements. Today, the company I'm going to talk about is Woolworths Limited. It's a Australian stock exchange company, and in the stock exchange is called W or W as a short form. In the coming slides, I'll be analyzing its financial statements and through ratios of profitability, liquidity, and gearing, and identify if it is in a secure place and whether it has a positive outlook in the coming years. As you would know, Woolworths Limited is one of the global conglomerates and has its business in Australia and New Zealand. Even though it has the business in the other countries as well, it has a majority of its footprint in Australia and New Zealand. And it is in the retail and the fast-moving consumer goods industry since 1924. And as you would see that it has a diversified portfolio in retail and selling food, liquor, fuel, and general merchandise, and it had a home improvement hub as well. However, like due to tough competition with the competitors in the Australian market from the company called Wesfarmers and the subsidiaries Coles, Woolworths is facing very tough times in the last 2 years or in the last 10 years, and it is going towards a positive and a positive bottom line and a positive outlook in the coming years because it has disposed its loss-making company Masters, which couldn't survive in the market due to the another company called Bunnings, which is also a subsidiary of Wesfarmers. And as you would see in the current financial statements, Woolworths has mentioned Masters as a discontinued operations and clearly shows that it has been disposed in the last year. And further to Masters, another company from Woolworths is Big W. It is a discount department stores, and it is also causing a prolonged losses over the years, and it is hitting the books of Woolworths 150 million loss as of June 30th, 2017, which is a setback for Woolworths and to its bottom line because for Big W as well, facing a tough competition from its other other players in the market such as Target, Kmart, and other many discount department stores because it's everywhere and like the competition is very fierce. So Woolworths has to make a decision about Big W as well in the coming years because it is holding Woolworths profitability for in the last years as well as in the years to come. So unless things work around in Big W and create a profit making company, it is tough for Woolworths to keep Big W and sustaining the longer market. In this slide, I would like to talk about the use of financial statements to the stakeholders, as there are various stakeholders for a particular company who are interested in the financial statements due to various reasons. For example, stakeholders are employees, media, union, suppliers, bank, and whoever interested in the activities of the company. Um, so in terms of Woolworths, there are the stakeholders would be majorly interested in basically three financial statements. They are profit and loss, balance sheet, and cash flow statement. If you take the profit and loss account, it is the for a period ending, it gives the profit or loss the company makes. So the people who are interested in the profit and loss account is the employees, media, unions. So basically it's whoever wants to know the company, briefly want to know about the company, whether it's making profit or loss, would take the profit and loss account of the company. So for Woolworths, the employees, media, unions would definitely look it up to identify if the company is making enough profit to increase the wages over time. And if you take the government, they would see if they are paying the taxes frequently and how much it is paid on their percentage of the profit. So as media and unions as well would be interested in the profit to see if the company is doing good over the time. Further, the next important financial statement is a balance sheet. It shows the financial position of the company on a specific date, and it is the assets and liabilities basically. So suppliers and banks basically would take the balance sheet and see what are the assets and liabilities it has, and see if the company has the potential to repay the loans and would have a good perspective in the future in order to do the business with them. So so the Woolworths suppliers would see if if they are if the Woolworths is eligible to give good supplier terms, supplier days for them to pay back. So these things depends on the balance sheet, as if it is strong and if it has a strong assets and if it has less liabilities, then it can definitely finance the loans and short-term debt obligations. Further, the last and important financial statement is cash flow statement. Cash flow statement is prepared since there are so many non-cash items involved in the profit and loss, such as depreciation and amortization. So these items are removed from the operating profit, and actual net cash inflow or outflow is identified through cash flow statement. And basically it breaks down the investing activities and financing activities and operating activities in the cash flow statement. So future investors and people who want to deal with the company over time would definitely look it up in the cash flow statement and see if 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 there is a positive cash inflow or a negative cash outflow over the time. And it also shows the management's management's ability to sustain and generate cash over time. In this slide, key assets or liabilities impacts on Woolworth's position is identified. So there are various assets and liabilities that are involved in the Woolworths, and in the last financial year, the Woolworths has hit by the major disposal of Masters, and it is a wise decision by the Woolworths management to discontinue the operations of Masters, which is the home improvement subsidiary, over the time. Since the investment of Masters, it has been a huge it has it has created a huge significant impact in the financial statements, and since it has been discontinued last year, same applies, like there has been various unusual significant activities, significant changes in the assets and liabilities last financial year. For example, the assets and investments has been decreased by 1,793 million. This is majorly due to the master's effect, I would say, and that's in the last financial year. And in terms of net capital expenditure, it has been increased by 683 million. That's purely due to the new stores investment and store refurbishment cost over the time. So so new stores meaning like a positive outlook towards the business, and I would say these figures are from the 2016 year-ended financial year, and I would say this has brought positive outlook to the company, because as of half year ended 2017, the revenue has increased as well as the market share has been bounced back by Woolworths over the time. So I would say this is definitely bringing positive impact in the stores over the time. And in terms of provisions, it has been increased to 3,255 million, and this is due to the again the master's effect, that store exit cost, it costs massive because the investment itself is massive for masters, because in order to do business with their other competitors such as Bunnings, the investment cost was significant, and like same applies when the exit cost. So excluding the master's impact in the financial statements, the actual increase is 83 million. That is due to the employee entitlements. So that is justifiable because it happens every year over the period of time. And another significant item in the financial statement is inventory, and it has been decreased by 340 million, and the significant items are related to masters. However, excluding masters effect, the inventory has actually increased by 40 million. That's due to the opening of new stores. So uh, obviously, like new stores involves new inventory because it has to store inventory in order to cater the new customers and new market. So just justifiable. Again, it has brought good financial results in this year 2017 half year ended. So having a positive outlook towards the years, we are hoping that maybe for the financial year ended 2017, Woolworths would give a positive results for the investors. In this slide, I'll be talking about how firms' key assets are measured in terms of accounting conventions. There are various accounting policies are used when it comes to preparing financial statements, and especially in terms of assets, liabilities, there are various methods that have been used in order to correctly identify the asset value and liability values in order to report it in the financial statements. For example, in Woolworth's financial statement, I have identified the revenue is measured at the fair value of consideration received or receivable, and financing costs are directly attributable to the acquisition, construction or production of the qualifying assets. That is, the one that is takes substantial time is capitalized, and the others are recognized in the profit and loss account. That means they are expensed in the profit and loss account. If it takes substantial time, then it's capitalized, and if it is not, then it's recognized as an expense in the profit and loss account. Further, the trade and other receivables are initially recognized as fair value and subsequently measured at amortized cost. After further analysis on the financial statements, I have identified key ratios for liquidity, efficiency, solvency, and profitability, and I have taken the company figures for the year ended 2016 and compared it with the industry average, and did an analysis on these ratios and given my point of view based on these ratios, and the analysis follows in the following slides. The financial analysis of Woolworths. In terms of financial analysis of a company, there are various ways to identify the ratios and do the interpretation. However, there are ways such as vertical analysis, horizontal analysis. But in the analysis follows, I have identified few ratios for profitability ratios and profitability, liquidity, solvency, and efficiency, and taken two ratios each and given my interpretation on those. First of all, for the profitability, gross profit margin. For the last year, it has been reduced by 1%, and this is due to the fierce competition and price war within the market with other major players such as Coles and Aldi. However, for year, the half year ended 2017, the sales has been promising, and it has been risen by the profit has been risen by 6.4%, and the market share has been taken close to 1% from coals as per the financial review data. The next ratio is return on equity. It is well below the industry level, and this shows that the grocery and the fresh food sector is creating positive results. However, the other loss-making subsidiaries such as Big W and Masters are bringing down the total net income of Woolworths. This is the reason for the lower return on equity of 4.8%. In terms of liquidity, the current ratio has been fallen to 0.83% in the year 2017, even though the industry norm and the well recognized current ratio is 2. It indicates that Woolworths has more liabilities than assets, and in the last year the creditors balance have increased by 332 million, and it justifies why the current ratio has fallen to 0.83%. The next ratio is asset ratio. It is sitting at 0.16 for the last year, and this shows the cash and cash equivalent to finance the liabilities. Since inventories take a longer time to move into cash and cash equivalent, it is deducted from the current assets, and the real cash and cash equivalent is identified as asset test. And since Woolworths has a major inventory balance in its stores, and the asset test shows the real liquidity position, and that is why it is sitting at 0.16% for the last year. In terms of solvency, the first ratio is debt to equity ratio. It is increased from 0.4% to 0.5%, shows either Woolworths debt has increased or the equity has reduced. Due to the discontinued operations of Masters, the shareholders' equity has decreased over the year, and just justifies why the debt to equity ratio has been increased to 0.5. The next ratio is interest cover. It reduced to 6.5%, almost half of the year before that. And the main reason is the profit has reduced significantly in 2016, and due to the main reason as Masters and Big W. So since the Masters has been disposed, in the years to come the interest cover should be back again to the 13.04, and more than what it is been sitting in this year. The next ratio is efficiency ratio. The inventory turnover is being reduced from 9.27 to 9.05. However, it's almost sitting in the same 9%. Even amidst reduced revenues, Woolworths maintains the ratio. It is quite good, but however, in terms of receivable turnover, it clearly shows that it's above the industry average, and Woolworths have to collect the debtors on time to make sure the credit policy is in control and it is secure in terms of cash and cash equivalent. The bar chart showing in this slide shows the Woolworths and Coles sales growth comparison from 2016 to fourth quarter ended 2018 as an expected figure. However, in the past 2016, it clearly shows the significant control of the retail industry by Coles, and how the sales growth has been increased until the end of 2016, and followed by 2017 quarter 1. Woolworth is starting to pick up the sales growth, and even like even the half year ended 2017 shows a promising quarter end for Woolworth. So in the next quarters, it looks positive, and the expectations to grow the market share, gain the market share back from coal is positive, and it is expected, and it should be well regarded by the investors as well as the employees. This sums up my presentation for today, and the understanding the financial statements of Woolworths. I have given my interpretations and my point of view in terms of the ratios analysis, and my point of view on the same. And this slide shows the references I have used in for this presentation. Hope you like the presentation. Thank you.